Welcome, everyone. So we're here to talk about active management styles in this environment, in this inflationary environment, as Michael Casey just mentioned. And I'm always reminded, we love the Alice in Wonderland memes and references in this industry. And in the context of this conversation, there's a perfect one to get us going, which is this one where Lewis Carroll says, in this place, you have to run just to stand still. And you have to run twice as fast to get anywhere. And that's the world we're in when we think of things like consensus and common wisdom when it comes to active management. And something like the 60-40 split that really helped orient the industry with an agreed upon strategy seems to be sort of losing its ability to be widely agreed upon as a way forward. And that's where we find Galaxy, really pushing the boundaries on how to discover what the new consensus model is for active management. Of course, we're nowhere near an agreement on it, but we've got someone who is exploring what this frontier looks like. So just to get us going here, that context of an agreed upon strategy in the macro context, how does Galaxy view that? Is the 60-40 piece and other forms of conventional wisdom, do they have any utility any longer, or are they completely useless and we should abandon any reference to that common knowledge?
Sure. So I think in investing, sometimes finding something that's easy is what investors look for. And the concept of 60-40 is just very easy. When investors are looking at their portfolio, trying to come up with complex allocation strategies, especially in the retail space, is just a little bit past what their capabilities are. So we're constantly looking for an easy model that somebody can replicate themselves. And to be fair, 60-40 isn't perfect for everyone, particularly given different ages, different needs. But clearly, in a world where we have to anticipate more and more financial repression from central banks to use that as one of their toolbox kits, that 40 piece is going to become more and more difficult longer term to generate returns. So when we're thinking about this, we're thinking, well, how do you resize that 40? Well, it doesn't necessarily have to be zero, but if the Fed continues to use interest rates and quantitative easing as a method for financial repression, they're forcing people out the risk curve. And where on the risk curve should you go, and where does cryptocurrency fit into that? So I wouldn't say that's a 60 equities, 40 crypto, but I think a portion of that is going to continually be directed towards cryptocurrency as the asset class continues to evolve and mature, and as investors need to reach for that extra capital appreciation to make up for the lack of yield they're getting in their fixed income.
So you mentioned, it's not so much beating the market as it is almost beating the policymakers. Has that change actually happened? Is that what we're actually talking about here? That it used to be the 60-40, all that orientation was really about we got to outperform the market itself as a general idea of a simple thing, it's a market. But now that the policymakers are literally putting their fingers on different scales and changing the balance of that market, is that really like psychologically where a lot of asset managers are? Do you think about beating the Fed now in a way?
I don't think about beating the Fed, but I think about listening to the Fed. Clearly, prior to QE, markets trended more in line with economic activity. When economic activity starts to slow, the Fed can reduce rates to try and stimulate growth. But now they need to supercharge that, and they've used QE to really boost liquidity into the financial system. I think what we've learned, and everybody knows the mantra, don't fight the Fed, is that you really can't fight the Fed. And that means don't fight the Fed when they're pumping liquidity into the system, and you probably shouldn't fight the Fed on the other side when they're taking liquidity out of the system. So I wouldn't say we're trying to beat the Fed in how we're investing, but we're really watching and listening and respecting what they're doing with financial conditions and what that means for risk assets.
So it's still beat the market, but the Fed's relative influence on the market still remains a very relevant factor when trying to come up with these strategies that can actually, help you beat the market.
Yeah, and I would say the relevancy of that factor continues to go up.
Yeah, and that I think is what brings us to the hardest part to chart when it comes to active management, because if that sort of influence continues to change, it'll be very difficult for us to come up with what you said, the easy way, what 60-40 was once. Right now, it seems like there's a million ways this could go, and it's almost like every potential option is on the table, including some complicated ones that wouldn't be easy, that would require a Series 7 license and probably an IQ of something that I wouldn't be able to contemplate in order to just beat the market. Whereas there was a time when anyone could beat the market because the wisdom of buy the index, buy the top performers was good enough. Now within those multiple strategies, almost a chaotic situation about what's out there, how do you make sense of deciding which potential strategies are right for you? How do you start really deciding where the holding part ends and where the actual risky portion of allocation begins?
Yeah, that's the crux of the question, really. I think what we've seen is, and I'd be curious, you've probably heard the word volatility if you've been sitting in here, 60 times today. But volatility changes, holding patterns with individuals, and whether that's emotional or needs-based. But volatility also creates opportunities. I look at volatility as an opportunity. So when we go back to kind of those passive buy and hold long-term strategies, you're essentially saying to yourselves, we're going to just weather the storm, and we're not going to try and take advantage of these market dips because we can't time that. And that means that over time, as policymakers reverse course and start to stimulate growth again, that we'll be fine on the other side of that. And with a long enough time horizon, you're fine. From my perspective, when you have this volatility and you have this signaling in the market, you should be trying to take advantage of that on the margin. Looking for opportunities to pare down risk, to increase risk, and reading exactly what those signals are to risk manage how you're doing that in your portfolio.
How do you, within that context, determine for each individual, right? Because everyone sort of has a different tolerance for this stuff. How do you personalize that? That's the part that, to me, continues to seem complicated, because if you have one situation that seems like it could work for the most amount of folks, is it really just their appetite and your counsel that allows you to shift that, barrier or that threshold in that way?
So I think the easiest thing to do then is to just size it appropriately for each investor. Right now in crypto, there are a number of different strategies across arbitrage, market neutral, long only, et cetera. But, we're trafficking in a lot of the same types of investments and a lot of the same types of tokens. The best way that I can think of right now to get to the retail level, individual by individual, is just make sure that the dollar amount that they're putting into it is appropriate for their risk profile and their needs. But as we continue to build out the ecosystem, we're going to have more specialized products, more niche products, kind of like in equities, how we used to just have a few big index funds, and now we have factor ETFs, we have style and size market cap based strategies. We're not there yet in crypto, but as we continue to move forward, I think we're going to be better able to pick the right strategies for specific investors and put those in their portfolio. And
you're starting to see, I guess we had the Fidelity announced a metaverse ETF, and not exactly related directly to the space, but obviously it looks like a lot of the incentives come from this industry that would make them think this will work. But how do you, so we have this whole piece, you know, it's buy Bitcoin and hold. That's the very simple, easy, you know, probably good for everyone approach for you know, having some risk but also hedging it. Now I want to talk about that active piece, right? Because when you open that up, that's where the portfolio construction elements become, I think, where a firm like yours is able to really distinguish themselves in understanding what would go in there. Because that's where you're starting to get into the complicated pieces for not just retail, even people with tremendous amount of experience and a tremendous amount of knowledge in the space would have difficulty. So how do you get into that piece?
Yeah, I think first we have to understand exactly what the investment is. It's not a commodity, it's not an equity, it's not a currency, but it has elements of all three. So, you know, a lot of times I get the question, well, how do you value this? And people want to see a valuation metric like you would see on an equity, but it doesn't really make sense. And then on the commodity side, of course, it's supply-demand based, which is true also in crypto. And then on the currency side with Bitcoin, it's what is the value of this? What will someone pay? So I think what we need to do really is to understand that we can't squeeze a specific valuation model or perspective into an old asset class. It won't work. So understanding exactly how these tokens or digital assets are structured is step one. I think number two is, what's the use case? What's the utility of this? You have to really understand what the digital asset is solving for, how many competitors they have, who else is doing this, how do they make money, how does the investor make money? All of these questions are very different than a traditional equity, which is still difficult for a lot of investors to really grasp, especially on the retail side, where they think it's okay, price goes up, buy. But there's a lot more underneath that we really need to understand before we're just putting capital to work in specific tokens.
Now, you know, a woman named Susan Athey, who I believe was on the short list to be the Fed chair along with Powell, did actually a bit of research in this field in 2016 or 2017. And she had a really unique perspective where she said we can actually take the market cap of industries and sort of reverse engineer the potential, just not for valuation, but for portfolio projection, construction, and trying to understand that stuff. She would say, like, you know, gaming is this much of the economy. So theoretically, there's this much room to grow for an application in this industry as a percentage of the total. Do you guys think, I don't mean the Susan Athey terms, but do you think in terms of the potential for gaming, for example, and what portion gaming would hold in a complete, if you were to paint a picture of the future, if you were to have one of these risk managers and forget that they're, you know, composing their vision of the future with numbers and spreadsheets, imagine it is an actual, you know, science fiction movie and we're in the future. Do you guys think that way? You know, is gaming, as it's going to be like a third of the industry, and so we need to find ones that would grow to that size and have the potential to that size? Is that something you do? You reverse engineer a vision of the future and find it in a portfolio?
I don't think I'm there yet. I think in terms of allocations, it's going to constantly be dynamic, and it's going to change over time. And you know, this is true in equities as well, when, surprising enough, Apple was bigger than the entire energy sector in the S&P 500. And when you look at what's working this year, energy companies are up substantially, but they were 2% of the S&P. They weren't always 2%. Back in 2005, they were closer to 8 to 10%. So it's dynamic based on kind of what else is coming out there. So we could set an expectation for where we think gaming is, and I can guarantee you we would be wrong. Because there could be a whole other market that we've failed to even consider would be a market. Or maybe game development tends to be a bit slower than we expected. So I think a lot of what we're doing in terms of sizing is based on where the specific protocols and where those specific companies are at this point in time, and then making sure to scale that over time based on the new protocols, the new companies, or the alternatives over time, continue to present themselves.
So when you say, we might get it wrong or we can make a mistake, I think of once again, the workhorses of this are these risk managers that are doing this, actuarial science that is highly sophisticated. But of course, these guys need to be able to bake in the opportunity to be wrong, right? It's important that they know how to be wrong and it not cost them everything. So we saw even just recently with Terra.
Yeah.
That's an example of, I think anyway, and correct me if I'm wrong, but an example of, we're taking a big chance, but how do you make sure you can take that chance with confidence? What goes into that piece?
Yeah, so risk, I think, is one of the most important things in crypto that we can pay attention to. I actually, the first 4 years of my career was in risk, so it's something that I hold very dearly to my heart. But, you have protocol-specific risk, like Terra, where really understanding the dynamics of how that works and when it doesn't work, what happens. And then you have risk as well from a traditional risk sense, volatilities, drawdowns, VARs, batting averages. But, risk requires a lot of data and a lot of pricing data. And the majority of crypto tokens out there probably still have less than just a few years of pricing data. So from a risk perspective, we want to see mountains of data so that we can really bring down that confidence interval to be a lot more narrowed in on what the risk of that portfolio looks like. And right now, you just have to keep it wider because we don't have that much data. So I think, again, it's an evolving asset class, but as we're getting more data, as we're able to really build out those risk models more appropriately to be similar to other asset classes, I think that's going to really help in this whole risk-reward equation that we're trying to do in constructing the portfolio.
So to bring this all, back to what you mentioned at the start, how to make this easy and coming up with a new consensus. I use a frame that I think is helpful. That not even to get into accounting, the troubles of inflation are literally the psychological engine that helps the economy going, perpetuating forward the reference of the U.S. dollar as a price for everything else you want to buy. The minute that starts changing and becomes unreliable, let's say, you're exponentially increasing the complexity of what's going on. How do you guys think of getting from that environment to an easy environment again, right? Is it even possible in an inflationary environment? Is it even possible?
I think it's very difficult. And I think we're in a very unique situation right now with inflation, partly because of the pandemic, partly because of the current war. And we can't replace a lot of those goods quickly. It's not as easy as, a manufacturer just ramping up production. People in Texas know, there's a lot of policy around fossil fuels. And to really drive some of that production higher, you need a little bit more political support. People have moved away from farming. It's not as lucrative as it used to be, and tech and finance have pulled a lot of farmer children into industry. So I think we have to kind of get through what I would consider a period of a bit of an anomaly before we can really try to narrow down with certainty what those allocations look like, because those allocations are going to look very different when you have all these extraneous factors which are really influencing financial markets.
Got it. Well, everyone, I'm getting bothered by the thing here telling us our session's over. Thank you.